the whole point of this conversation, this is super casual. So I really want everyone to just jump in and ask questions. And let me know really whatever's on your mind. This is meant to be a conversation. Um, so yeah, with that, I will go ahead and share my screen. You can also feel free to put questions in the chat if you'd like. And give me just a second to share my screen. Hello, Shekhar. Welcome.
Hey, how are you?
I'm good. How are you?
All right.
I'm not sure. I don't think we've met before.
No, we did.
Oh, this is Is this Chandra?
Yeah.
Oh, okay. Sorry. It says Shekhar. I don't know who that is, but yeah.
Yeah, that's my middle name. Actually, also my generally the default name.
Okay. Awesome. Well, thanks for coming. I was just letting everybody know that this is meant to be really casual and conversational. So, we're going to have fun. We're going to tell stories and yeah, just jump in with any questions that come to mind. Okay. Okay. And with that, let's see. I'm going to go ahead and present. What's that? Okay. So, as you guys know, I invest in real estate. I've been investing, and this class is supposed to be, it's about single family versus multifamily investing. And we're going to look at a case study. And it's going to be fairly high level, but the idea is to just give you a basic understanding about real estate investing and, whether a lot of people come to real estate investing in single family homes, myself included. My first investment was a single family home. And it takes a while, but oftentimes people eventually come around to learning how to invest in multifamily or apartment buildings. And there's a whole world of investing even beyond that. But multifamily is usually the first thing that people begin to look at. So, going to go ahead and click the slide. So just a little bit about what we're going to do today. First, I'll just go over a little bit about myself. Then we're going to talk about why investors are diversifying. And we're going to go over a case study of a single family home purchase versus a multifamily investment. And, we have some other topics to consider just depending on the time and how things go. So just a little bit about me. For those of you who don't know me very well, I was born in California. My parents came over here from India in the 1970s. I've been in Portland, Oregon since 2010. My experience in real estate goes all the way back to 2010 when I worked for institutional buyers who were purchasing apartment buildings. So I kind of come from the banking world, and that's like sort of where I cut my teeth and how I got my experience learning how to analyze transactions in apartment buildings. I started to invest myself with flipping a house in 2010. We ended up holding that house for 5 years and then selling it for, 5 times what we bought it for. We already paid it all off. But, that was a one-off, right? And it was also kind of a pain. So I wasn't really eager to do that again. I ended up building my own real estate portfolio of Airbnbs, though, because they had much higher cash flow. It was totally an accident. I did not mean to become an Airbnb entrepreneur, but it was just such a good business and produced such high cash flow that I just kept adding more units to my portfolio. And then I realized I needed to invest that money. Like I wanted to, diversify my streams of income. I didn't want to solely rely on Airbnb, and I wanted to put that money to work in a really intelligent way. And all paths led to syndication investing, which is essentially when groups of people pool their time and their money and their resources and their knowledge and expertise to purchase apartment buildings or the likes, maybe self-storage communities. And through this, we're functioning as a team rather than each individual investor kind of going it alone. And in my opinion, the reality is you can actually just get a lot more for your time and for your money when you work as a team together. And so we're going to go over what that like might look like. Another thing that I learned early on was earn, invest, repeat. Like in order to build the wealth that I wanted to build, as well as the cash flow streams that I wanted so that I could live life on my own terms. Because that's really why I got into this is I just didn't like having to go to a job and having to tell my boss when I wanted to take vacation and, you know, having a cap on my salary. Even if there was a bonus, it was still, it was still a cap. So I learned this concept, earn, invest, repeat. So I learned that I needed to earn as much money as I can, and then I needed to put that money to work, and then I needed to do it again. And at the same time, I needed passive streams of cash flow, because the passive streams of cash flow is what allows me to live life on my own terms. So I don't know how I figured all this out. I just kept learning one thing after another, just like you guys are here today, learning something today. And yeah, so it's all a journey, and I'm happy that we're here today. This is just like a couple pictures from my life. There's my family, my mom, my dad, my sis. Well, actually, that's Zach, my brother-in-law, Ben, my partner, my sister and her child. My mom and me are on the bottom right. And then there's my mom and dad and me in the middle. I love to go camping and kayaking and adventuring. Ben and I enjoy roller skating. So that's a picture of us roller skating. And yeah, that's a bit about us. Okay. So let's first talk about why investors are getting into apartments. Why apartments? So instead, and this is instead of single family homes. So one reason is diversification. When you invest in apartments, you can easily diversify across asset classes, meaning like you can do some value add deals, which is when you're renovating units. You can do some new construction deals, which is when we like to buy new buildings that are already built, so we don't have construction risk. You can diversify across geographies very easily. You can take a small amount of money, like maybe $100,000 or $200,000, and put it in 4 different properties. So diversification is just, it's always good to understand how your portfolio is allocated and not put necessarily all your eggs in one basket. My favorite way to diversify is to have a real estate syndication portfolio that is diversified. So personally, I'm in apartments, I'm in self-storage, I'm in mobile home parks, I'm in some medical office space, some industrial. So there's a whole world of different asset classes, and that helps me diversify within real estate. I'm also diversified across operators. So I invest with multiple deal sponsor teams, so multiple on the ground teams that are actually running these deals, and then multiple geographies, right? So I really like this particular way of investing, really fits my profile. And again, make sure to, let's see, I think there's a chat. Chat says, yeah, so I have all paths led to this for me. And the way that it led to this was, well, one, I started out in this space, but two, I started on the space working for institutional buyers. But I've also, I've gone to multiple conferences, I've read many books, I have listened to thousands and thousands of hours of podcasts. I've taken classes on due diligence. So I've really studied this space for the last decade. And as there's always more to learn, right? Okay, so I want to get back to why apartments. So rewarding returns. A lot of people are really happy with 5%, 6% returns. And I think, that works for people who've already grown their wealth, or for people who maybe aren't that motivated. But I want my income to snowball. I want my wealth to snowball. I know that that's necessary in order for me to live the kind of life I want. And so I want higher returns. And the syndication investing can provide that. We're usually projecting, in the kinds of deals that I'm investing in, we're usually projecting 18% to 20% average annualized returns, which sounds like a ton, right? For the average investor, that sounds too good to be true. In future classes, we're going to get to how it is that we create so much value and how we can provide those returns. Okay, number 3, buy back your time. When you invest with a team, you get your time back, because for any of you who've owned rentals, you may know that it can take work, right? Like you sometimes get a call where you have to go attend to a plumbing issue, or your property, if you have a property manager, your property manager tells you that the roof needs to be repaired and they can't pay for that, right? So you need to pay for that. You might have a vacancy and then you need to deal with getting a new tenant. And in the interim, you may need to pay the mortgage. And that might come right out of your paycheck. So when you invest in apartments, you buy back your time. You're not responsible when you're a limited partner for the day-to-day operations. The deal sponsor is responsible. Okay, number 4, limited liability. You're also not liable as a limited partner or a silent investor when you invest in an apartment. You're limited. So like I said, if a tenant moves out in a single family home, then you've got to make sure that mortgage gets paid the next month. If the roof gets fixed or gets leaky, you've got to make sure that that roof gets fixed. And I will tell you that something's always going to come up in terms of repairs. It's hard to know what, but something's going to come up at some point, especially if you're investing for multiple years at a time. Okay, number 5, pass-through tax benefits. This space, multifamily investing, is very tax advantaged. I'm not going to get into the weeds with that right now, but it's just something to know because we need all the edges that we can get to build wealth. And when it's not how much you make, it's how much you keep. And taxes is a big way lowering your taxes is a big way to make that. And I got a question, do you invest solely in real estate? And the answer to that question is that I almost only invest in real estate. I do have a stock portfolio that was left over from my 401k. So, I always just contributed kind of like the base amount that I needed to get an employer match. And so that money is still invested in stocks. But literally the rest of my money, which is probably about 95% of my net worth, is invested in real estate. Now, about a third of that is in my syndication deals, and the other, 2/3 of that is in the physical properties that I solely own. So, but I'm all in on real estate. So thank you for that question. Again, keep the questions coming. And lastly is impact. When you invest in apartments, you get to change the lives or improve the lives of hundreds of families at one time. If you have a single family home, if you've ever rented a single family home, you know that you're providing a home for that family. You're providing safe, clean, and affordable housing for that person, couple, family, etc. When we invest in apartments, we're improving entire communities of people. We're making them nicer places for people to live, nicer places for kids to play on the playground. We're making them, there is a lot of housing stock that needs to be updated so that people can feel a sense of dignity and pride and home where they live. And we get to do that when we improve these apartment buildings. And then, lastly, I would say build and protect wealth. In terms of all the opportunities that I've looked at to build and protect wealth, real estate syndications is my favorite because, again, of all the reasons that we just mentioned. Okay, so now let's dive into the case study. So let's say, for example, that you have $50,000 that you want to invest and you're going to invest it over a period of 5 years. So let's say you find a single family house, this one pictured right there. You're able to buy it for $250,000. So you put $50,000 down or 20% down payment, and you bought a $250,000 home. After you pay all of the expenses and pay the property manager, and you will get $200,000 a month, or sorry, $200 a month in cash flow. That's, actually a pretty good amount of money for a lot of people who are just buying houses with a mortgage. $200 in cash flow a month. And then on top of that, you do have a property manager. So you have a property manager who's helping to save you time. They're paying for the utilities. They're finding the tenants. They are making sure that the place isn't vacant for too long. And I got a question in here about tax benefits. So yeah, like I said, this is conversational. So I want to answer that question really quick. So the question is, can you talk about tax benefits more and how depreciation benefits that we have, are they recaptured at the time of sale? So this is a kind of a complicated question, but essentially the tax benefits that we receive in real estate are in the form of paper losses, or depreciation is another term, and we can accelerate that depreciation. And that creates losses, which you can count against other rental income or against the income that you get from the syndications themselves. And so that depreciation comes up front. There is depreciation recapture upon sale. So the question, I did repeat it once, but someone I think didn't catch it. So the question was, can you talk about tax benefits more and how the depreciation benefits that we have are recaptured at the time of sale? So it's a little bit of a nuanced tax question. The idea is that first you get depreciation benefits up front, but then there's recapture on the back end. So if you want to continue to defer taxes, there's two ways to do that. You can either 1031, sometimes the investments, even with us, can be 1031 into another deal, and then you can continue to defer those taxes. You can also just invest in another syndication in that year of sale, and then you'll be able to count the losses from the new deal against the recapture from the previous deal. And number three, if you can also learn to invest in opportunity zones, in those cases, then there's no capital gains taxes after 10 years. So that's another tax strategy. So depreciation recapture is something to consider. But the main point is that even with the recapture, you're still able to benefit from the time value of money. Time value of money is this concept in investing that means that, if you're investing more today, then it's going to grow really fast. It's going to grow faster than if you were to invest it in year 5. So, I mean, that's kind of an overview of that particular issue. Okay, so back to the example. We bought this $250,000 home. It's cash flowing $200 a month. And we've got a property manager who's taking care of the day-to-day operations. So that's pretty cool, right? It's pretty cool. However, I'm here to tell you, like we said, that there's going to be what we call repairs that are not covered by the property manager. So the roof might leak and needs to be fixed. The plumbing might need to be attended to. The water heater might need to be replaced, or the dishwasher, or if you have a tenant that moves out, you might have vacancy, and that will also be a cost to you. And then you'll also have to turn the unit at that time. So you might have to repaint or redo the carpet, depending on how long they've been there and how poor of state it is. So there are going to be these extra costs that aren't included in this, that aren't accounted for yet. So we want to account for those, right? So as a conservative measure, let's say $10,000 over the course of 5 years, which is $2,000 a year. Let's assume a $10,000 expenses. Do you send out a recording? I just got another question. Do you send out a recording? Yes, I do send out. We'll make sure to send out the recording. Okay, so $10,000 for repairs. So we got to take that into account. Okay. All right, let's get into the calculations now. So what is the profit from the cash flow? $200 a month times 12 months times 5 years equals $12,000. Okay, pretty cool. Now, at the end of 5 years, let's say that we're also going to sell this home. Okay, so let's see. Here we go. I needed to switch these slides. So if we sell the place at the end of 5 years, let's assume the place is in a pretty good area. It's going to appreciate at 2%. And that means that after 5 years, the property will be worth $275,000. So that's a net gain of $25,000, right? Pretty cool. Yes, however, there's still costs associated with selling. So if you want to get that money back after 5 years, then you've got to sell the place, which means you've got to subtract the selling costs. Oftentimes, those are about 8%, which is $22,000 in this case. That leaves you with just $3,000 of profit, which is not that great, right? So something to consider. Okay, so I'm going to come back to that slide. But there's some good news. You also might have paid down your principal and the amount of $20,000. So you look, that would be about an average that you would have paid down your principal. So as you're making your mortgage payments, you're paying your principal down. So let's do all the numbers together. You paid your principal down of $20,000. You've got monthly cash flow of $12,000. You earn $3,000 from the sale. So all of that equals $35,000. Now we've got to take out the $10,000 in repairs. So that equals $25,000. I got to go back to this slide. So total gain of $25,000, divide that by 5 years, and then you get $5,000 a year, right? 25,000 divided by 5 is $5,000. $5,000 divided by $50,000 equals 10%. So that means the average annual return, if you were to invest, if this was in this case study of a single family home rental, would be a 10% return over 5 years, which is pretty good, right? I mean, it's certainly better than you would get if your money was sitting in the stock market or sitting in a savings account or a CD. And it's even better than, what you would get over the stock market, in the stock market, generally speaking. So not too bad, right? Okay, well, now let's go ahead and look at the multifamily syndication. So let's say you decide, okay, I'm actually going to put my money into a multifamily syndication. I've got $50,000. I'm going to put it into this deal. It's supposed to last 5 years. I'm going to get 8% cash on cash return. And I'm going to get a 1.95x equity multiple. So let's go over those terms. What is cash on cash return? Cash on cash return is the money that you get during the hold period. So we're collecting rents and we're increasing rents over the hold period. And when there's distributable cash flow, so after we pay our expenses, after we pay our mortgage, after we pay for trash and recycling and water and sewer and electricity and property management, insurance, etc., there's distributable cash flow, right? Just like there was that $200 in cash flow in the single family home rental with apartment buildings, there's distributable cash flow. So we also, however, in multifamily syndication are going to account for the capital expenditures. So we hold reserves at the property so that we can make sure that we always have enough to cover our bases if there is a repair, which there will be inevitably. So 8% cash on cash return means that on average over the 5 years, you'll be getting 8% cash flow. So if you put in $50,000, that's $4,000 a year on average in cash flow. Also, the deal projects a 1.95x equity multiple. So we'll go over what that means in a second. These are important terms to understand so that you can analyze, what is this deal going to do for me in terms of the actual numbers. So 1.95x equity multiple means that over the 5 years, the deal will return to you a total amount of capital of 1.95 times $50,000. So 50,000 times 1.95 equals 97,500. That's what you'll get back from this investment over time, assuming the deal performs to projections. Every deal has target returns, and we like to make our target returns conservative, but it's still a target, still a projection. So 50,000 times 1.95 equals 97,500. 97,500 minus the original principal of 50,000 is 47,500. And that means the average annual return in this case is 47,500 divided by 5 years. divided by 50,000. And that equals a 19% average annual return. So that is a really, really great return. It's especially considering that it is in a hard asset and in a recession resilient asset class. So there's a lot of insulation in this particular asset class against regular market dynamics, market volatilities. Okay, so to make it even sweeter, sometimes, usually we're going to try to refinance the deal. It could be in year 2, 3, or 4, but we're going to do a cash out refinance whenever we can. It's harder in an interest rate environment like this because obviously interest rates are high. So people may or may not be doing refinances right now. And then we'll return the $50,000, which you can then roll into another syndication, which means that when this does happen, you can get your money to work for you twice. And then things really start to move really quickly. Okay, got a question in the chat. Cash on cash is 4%. When is the $47,000 paid? Okay, so cash on cash is actually 8%. It's just $4,000 on $50,000. So 8% of $50,000 is $4,000. So cash on cash is 8%. The remainder of that $47,000 is paid on sale. And so we create, and we're going to go over this depending on how much time we have. With multifamily buildings, we can force appreciation. So we can really drive up the value of a property. And we do that because multifamily properties are, the value is based on the income, the net operating income. So to this person's question, it's $4,000 times 5 years is $20,000. And then 47,500 minus 20,000 is 27,500. So in this scenario, you would get 27,500 at sale. Okay, cool. So let's go ahead, and now that we've looked at 2 situations, let's ask ourselves a couple of questions. So, will real estate investing give me better returns than the stock market? And in both cases, single family versus multifamily, the answer is yes, absolutely. The stock market has returned an average of 8% over the last 40 years. And obviously there's times when it's growing quickly, and then there's times when it's falling really quickly. So yes, real estate investing, either single family or multifamily, will give you better returns than the stock market, assuming that the deals are somewhat like this, which are pretty standard deals. And then number 2, do I really want to be an active investor? So with the single family home building, that was an active investor. You have to be an active investor if you want to own a single family. Even if you have a property manager, you're still an active investor because you're still responsible for the mortgage. You're still responsible for the roof repairs, etc. So that is a great strategy, but you have to consider, do you have the expertise, knowledge, resources, and time? I got a question. Can you show a sample deal in a table year by year, return, and finally upon exit? I do have one of those tables, yes. So let me get to that in just a moment. Okay, so do you have the expertise, knowledge, resources, and time? So I think that's a really good question, and it's important because depending on where you are, you've got to accurately do an accurate self-assessment of where you are with your finances and what you need. So when I first started investing in real estate, I didn't have any money to invest. I didn't have any money to invest. So I couldn't do real estate syndications because you need $25,000, $50,000 to invest in real estate syndications. So I was an active investor. I bought a cheap rental house and I flipped it. I renovated my basement for like $4,000 and turned it into an Airbnb. And so I had to do that, right? So if you don't have the money, but you do have the time, then you can be an active investor. But if you have the money, but you're short on time, then syndications may be a good choice for you. I'm all for people doing both because oftentimes people need to both earn more money and invest more money. I think the key question is how can you earn the most money for your time so that you can then put it into an investment vehicle that matches your risk profile and matches what you want to achieve as far as returns. Okay, so I'm going to go ahead and I'm going to come back to this slide and go to the slide. Someone asked to see a slide. So this is a different deal, but it's another sample deal. So in this case, the investor invested $100,000. Okay, so we've got year 1, 2, 3. In year 3, there's a refinance at 4 and 5. So let's go over each row. So here's annual cash on cash return. So in year 1, the deal returns a 10.5% cash on cash return. In this scenario, in year 2, it's 11.6. Year 3, it's 12.1. Year 1, it goes down often in year 4 and 5, and there's a reason for that. We'll get to it later. And what does that equal in terms of dollars? So these are just 10.5 times $100,000. So that's what you get in terms of dollars. In year 3, there's a refinance. In this case, the refinance returned $39,000 of original capital. So now the investor can take that $39,000 and reinvest it in another deal to keep that money working for them. So the total cash flow, this is the total cash on cash return is $52,000. And then the proceeds from sale. So we're going to talk about how you force appreciation. But the total proceeds from sale are $47,000 or so. So the cash flow is $52,000. Going to get your $100,000 back. Some of it's going to come in year 3, and some of it's going to come in year 5 when we sell. And then the total amount of cash back is $200,000. So in this case, the total return it's like a 2x equity multiple because we're doubling money in 5 years. And the IRR is a 19%, which is really high. So not all deals are going to look just like this, but that's an example deal. And I'll just go over some of these. So total return 100.4 over 5 years. Then when you divide that by 5, that equals 20%. Cash on cash average 10.59. So that's just the average of these cash flows from the rent. And then the IRR is 19. So IRR is a return metric that includes the time value of money. So the time value of money is a really important concept in investing. $1 today is worth more than $1 in a year. That's super important. It's always true. It's especially true in times of inflation, right? We have high inflation right now. So that's the return model. Any questions on the return model so far? I can just go ahead and go over what these other notes mean. So investors will receive an 8% preferred return. So what is a preferred return? A preferred return, it means that you have preferred equity. And what that means specifically is there's a capital stack. So the capital stack determines who gets paid first. So the first person to get paid is the bank. The bank always, you have to make your mortgage payments or they're going to take back your house. And it's the same with apartments. You have to make your mortgage payments. Then there can be second position debt, which we won't get into right now. Then there's, let's say you buy a house. You buy a house and you got to put a down payment down, right? So that's your equity. In apartment buildings, we also have equity, but usually it's split up into, usually it's I lost my train of thought because I was looking at the chat. So let me just go ahead and answer this question really quick. Would we be able to reinvest yearly returns? How? So that's a good question. The question is, would we be able to invest yearly returns like this $10,000? So there's some funds where the returns can be reinvested. That's not typically how I've done things. I may offer that in the future, but currently in the deals that we're offering, we don't offer that. So the best way to reinvest your funds is to make a new investment. So if you get $10,000 of cash flow, then perhaps you have another, you can make another. I allow people to invest in $1,000 chunk. So if you want to make like a $36,000 investment, you can make a $36,000 investment into your next deal. So that's kind of the answer. There's some funds that allow you to reinvest. That's not something that I offer, but it's something that I would look at. Okay. Oh yeah, preferred return. So we're talking about the capital stack. So then there's two types of equity. There's preferred equity and there's common equity. So the preferred equity gets paid after the bank. And so that's what a preferred return is. And the reason we have a preferred return is because it's super important that everybody's interests are aligned. So this deal sponsor, that's the sponsorship team, the on-the-ground team, they need to be motivated to perform and they shouldn't be financially compensated too early. So the way we protect the investors or the passive investors who have no control over what happens in the deal is that we have a preferred return. So passive investors are legally required to get 8% distributions out of the distributable cash flow before the sponsor team can start taking any of the profits. And so that protects the investors and creates alignment of interest because the sponsor team is motivated to get to that preferred return so that they can start taking cash from the distributable cash. So that's what that means. After investors receive their 8% preferred return, and that's usually cumulative. So if you don't receive 8% in year one, then maybe you receive 12 let's say you receive 4% in year one, and then you receive 12% in year two, then you've received an 8% distribution over the 2 years. At that point, distributable cash flow that comes through the deal is going to be split 70% to the limited partners or the investors, and then 30% to the sponsor team. So that's what this 70-30 split means. And, not all deals are going to have a 70-30 split. Some are going to have more. And I think it's important to note number 2, all numbers are net returns. So in these deals, we're always showing returns to you net of any fees, etc. And that's not always true, with certain other financial instruments, is that they don't necessarily show you the fees. They don't necessarily take those out. We always show returns net of fees. So sometimes so how do the sponsors get paid? So it's important that sponsors be able to keep the lights on. And in order to keep the lights on, we take some fees during the process. So usually there's an acquisition fee. That means in this case, it's 2%. So 2% of the purchase price goes to the sponsor team, and that helps them hire more people if they're growing their staff, helps them pay for operational expenses. And that's important for the sponsorship team too, to have a little bit of money, because if the sponsorship team doesn't have anything to run on, they're not going to necessarily have the capacity to run your deal well. And same with the asset management fee. In this case, there's a 2% asset management fee. That means that the sponsor is collecting 2% of it can be done in different ways. It can be 2% of the capital invested. It could be 2% of the rents. So there's different ways of calculating that. So yeah, I think I'll go back to this other slide that we were on. Okay, last question to evaluate, which way do you want to do? Do you want to go it alone or invest with a team? Most real estate investors go it alone. Most real estate investors own their own investment properties, and they go it alone, and that they're responsible for the mortgage payments, for the repairs, etc. And there's lots of good reasons to do it this way. I have a very high cash flowing Airbnb portfolio, and that's just mine, right? Like I'm responsible for that. It produces a lot of cash flow for me though. And so that's why it fits into my investment strategy, because that's the way that I earn, one of the ways that I earn cash. But then in terms of making the most of my money, I like to invest in real estate syndications. For me, it fits my investment profile perfectly because I am risk averse. I don't want to lose money. So real estate syndications are backed by hard assets. And but they also produce really high returns, as long as you invest correctly. So it's so key to understand your situation and your goals to decide what you want to do with your money. Are you in a position to keep investing in real estate syndications, or do you need to figure out a way to earn more money? Well, then the next question is, well, what are your goals, right? So taking another step back, like, what is it that you really want for your money? Do you want more time? Do you want to have more security in your retirement? Do you want more cash flow? Do you want more peace of mind? These are all really important questions. And, I'm happy to talk those over with anybody, anytime. I've been doing a lot of talking. Any other questions come up? What are you, Jennifer? I'm being nosy. Are you drinking a beverage or anything right now?
I'm not at the moment, but I do have water nearby.
Very cool. Cool. Well, okay, I got a question in the chat. Let's see. Airbnb takes more of your time. Also was a problem during COVID. So it helps to have other things like syndication. Yeah, that's true. So for those of you who know me, you know that I'm dealing with my Airbnbs, when I'm on vacation, like a guest needs something or something happened and I need to deal with it or ask somebody to help me with something. So and also it does take time. And for me, it was my only source of income for a while. And that wasn't good for me either, right? Like, I understand that I want multiple streams of income. I don't want to be fully reliant upon, short-term rentals in my Airbnbs, because that's not a well-diversified position. So that's why I added syndications into my streams of income, because now I get cash flow from my syndications. And it's also another business for me. So diversifying your streams of income is, I think, an important thing for anybody to consider. So good point. Any other questions? I know I want to respect everybody's time, but curious to hear if this makes sense, or if there's anything that comes to mind as far as questions. I don't know if this is super basic for you guys or if this is new information. Let me know if this changes how you think about real estate investing or investing in general.
Suja, like this is Mo. I have a question.
Hey Mo, what's up?
Yeah, so basically, I mean, the case studies you have shown are very interesting. So, but like, if you take if we are talking about a deal in 2023, what is the average size of deal and what is the expectation from an investor, to put the money in, like, so can you give an example, like a recent deal? What is the total, the purchase amount, and how many investors we had? So that will give us an idea, like,
Yes, for sure. So let me see if I make sure I understand what you're saying. So you're wondering if I could share an actual deal of like how many investors and what we purchased it for?
Yeah, like,
Okay. So I think I have some of those slides later on here. So, okay. So here's an example of a property that that we syndicated. I'm on the general partnership team. So this is actually a very small property, Mo, compared to what we normally do. But just so you know, this is kind of like an example. So this was a 10-unit property in Washington State, had all 1 bedrooms, and it was a Class C apartment building. So the purchase price was $735,000. The equity contributed was $280,000. So it's about a third of the purchase price. And so, that there's about 15 investors in that deal, I would say. So about 15 investors are the equity constitute the equity. Okay, so let's go on. So let's say we raised the rent by $1. So if we raise the rent by $1 on each unit, then we would get an extra $10 per month. Then that equals an extra $120 a year, right? $10 times 12 months is $120 of extra cash flow per year. So the next thing that we need to do is we apply a cap rate. So a cap rate is a way that commercial real estate is valued, and the cap rate can change based on market conditions and based on which market it is. So 5% is kind of like a standard cap rate. But when the economy is getting hotter, then the cap rates are going to go down. It's called cap rate compression. And then when the economy is getting worse, the cap rates are going to go up. And basically what that means is when cap rates go up, then people are just willing to pay less for the same income stream. But in any case, 5% is a fairly standard cap rate, okay? So you take $120 and you divide that by 5% and you get $2,400. So when we raise the rent by $1 on each unit, then we created $2,400 of value at the property. And what's cool about that is that, here's my calculator, is that $2,400 is about, well, it's about 1% of the equity that we raised, right? We had $280,000, so it's about 1%. So just by raising the rent $1, we increased our equity, the value of our equity by 1%. Now let's say that we were able to raise the rents by $10. So then all of a sudden we made $24,000. We increased the value of the property by $24,000. And $24,000 divided by $280,000, which is the total equity, is 8.5%. These are kind of like basic calculations. So obviously there's going to be a few other numbers that are involved, but this is just to give you an idea of how powerful it is how commercial real estate is so powerful. And then to give you an idea, we've already raised the rents at these properties. We've owned this property since COVID. So it's been 2.5, I guess almost 23 years now that we've owned this property. And we have raised the rents about $150 to $200 a unit on each property, on each unit. So let's see. Here we go. So we raised the rent $150,000. So, or sorry, $150 on each unit. So that's $1,500 extra in cash flow per month. That's $18,000. And that equals that equals $360,000. So we've increased the value of people's equity by, over 100%. Now we haven't sold the property yet, so we haven't realized those gains for people, but that gives you an idea of how these deals make money. Does that answer your question, Mo?
Yes, thank you.
Okay. And then just to follow up on that, so oftentimes, that was kind of the first property that I did, and it was pretty small. I mean, purchase price of less than $1 million. These days, we're looking at properties that are usually, $20 million. We did buy some property portfolios that are like $100 million. So we do bigger deals these days. And the benefits of that are that it's more scalable. It's usually the returns are even better, and more investors can get into those. Obviously, this deal, there was only room for $280,000 of equity. That's not really that much. Okay, so got a couple questions about that. Please remember to tell us how you force appreciation. Okay, so I think there's some slides about this over here. Okay, so what is forcing appreciation? We just talked about how we are able to increase the value, and we increase the value by increasing the rents or decreasing the expenses. So we need to increase the net operating income, which leads to distributable cash flow. So we increase the net operating income by either increasing rents or decreasing expenses. So we can decrease utility expenses by making the property more efficient. We can improve staff efficiency. So sometimes staff are not, we can optimize staffing operations. We can also add ancillary income like pet fees, valet, trash, reserve parking. If you add a pet fee, which is like might be $25 a month, if that's on 50% of the units, that's going to make a big difference on the value of the property. People will pay for reserved parking. They want to know that they have a parking spot and where they park every time. Sometimes trash cans are far away and they don't want to, people don't want to necessarily go that far to drop off their trash. So they pay for valet trash. Another way that we increase, a typical way that we increase the rents is that we are going to be, we improve the units. So we actually renovate the units. So I got another question that's related. How do you justify suddenly raising the rent? So on a lot of these units, there's two different types of rent growth. There's organic rent growth. Organic rent growth is when market rents are just appreciating. So you can take the same unit, just clean it up, not do any renovations, and you can rent it for $100 more per unit. So we justify that because that's just what the market is demanding. That's what the market is saying, is that people will pay $100 more per rent. The other type of rent appreciation is due to improving the property. So we make the property nicer, we make the units nicer, we improve the bathrooms and the kitchens and give it a whole new fresh paint of coat and make the fixtures nicer and modernize it. So those are the ways that we did that. In the case of the 10-unit property that we discussed, we have done a combination of both renovating units. Usually there's a combination of organic rent growth, which is just natural market appreciation, and forced appreciation, where you are improving the units, etc. So there is definitely a lot more that we can talk about on this property, but I think I'll just end on this slide. So what if you invested $50,000 per year? So let's say you had $50,000 a year to invest. And what would happen if you invested $50,000 a year in syndications? So after 20 years, and we're assuming, this is assuming a 15% IRR, and it's also assuming that we take out some money for taxes. So we're just paying the taxes every 5 years. So after 21 years, you'd have over $3 million if you invested $50,000 a year. And so that is the power of compounding interest. And that is the power of exponential growth, because with compounding interest comes exponential growth. And I do have a calculator that I just created for myself that shows that. So if you want the calculator, you can just email me and I'll send it over to you. And also feel free to, if you want to talk over your specific situation, there's nothing I love talking about more than helping people figure out their money. So please feel free to grab a time on my calendar. And, even if we've talked before, or if there's, even if you want to update me on your current situation, please just book some time on the calendar. I'd love to chat. And yeah, we're getting close to time. So are there any more last minute questions? I guess I have a question. I have a question for you, Mo, if you don't mind. I was just wondering if were you asking about like a deal that we have in 2023 did you want to see a current deal?
Sure. If you have any details you can share, so I can check.
Yeah. Okay. Well, so we actually do have a deal that's open right now. It's a short-term rental offering, and we invested in it last year. Some of you, I know, some of you are on this call, you're already invested in it, but we're investing in their second fund, and So far, the fund is going really well, and we're excited to invest. This time, only accredited investors are allowed to invest. An accredited investor is, we can talk about that, but either there's a net worth requirement of $1 million outside your primary home, or there's an income requirement of $250,000. And so I will make sure to send that out to all of you who are here. And okay, so I got a question about due diligence, and we don't have to worry about. So that, I think that's a good point. So, all this stuff, like your money is going to grow like into $3 million if you invest $50,000 a year. That's all good in theory, but how do you know that things aren't going to go wrong, right? Like things do go wrong in real estate. People do mess up, and people do lose money, right? Like it's an amazing tool, but it doesn't always go well. And so how do you know that you're putting your money in a good place? And so that's kind of where I come in. My goal is to provide investors with investment opportunities that are pre-vetted, so they don't have to worry about them. I do due diligence on the sponsors. I have studied this space very closely. I have a podcast, so I'm meeting people all the time. I go to conferences. I'm constantly evaluating people's people and their business models, and making sure I'm also, I have the experience of working for banks and doing extensive due diligence. And so I put that into practice because, and that way investors don't have to worry about where they're putting their money, because these are deals that are not actually registered with the SEC. We do have to comply with SEC regulations, but because of our space, we don't have to actually register the investments. And so it's just really important that you are careful about investing in these deals. You don't want to just put it in any deal. A deck can look really good. You can make any deal look really good. But what's behind the fancy PowerPoints, etc., always matters way more than the actual PowerPoint. So, and that's kind of my job, is to figure out what are the best deals to invest in. And then another point is that I'm always investing alongside my investors. So in every single deal, I invest my own capital. I'm creating the ideal investment portfolio for me, and I'm inviting my investors to invest alongside it. My family also invests in every deal, and that way our interests are aligned in more ways than one. So yeah, well, we're right at 6 o'clock. I want to make sure we respect everybody's time. Thank you so much for coming on. You guys, it's been really fun to have you all here, and got some veterans in the room, people who are part of our community. Hopefully you learned something new today. And for those of you who are new to syndications, I hope, it wasn't like drinking from the fire hose too much, but thank you everybody so much. Yeah, I guess with that, I'm gonna say goodbye. Bye.